Good morning, grade 12. We are starting with chapter 6 today. As from today, it is extremely important that you stay with me day by day. You cannot fall behind. If you are already behind, you need to stop what you are doing or carry on catching up, but also do the chapter 6 work that I give you. By now, you should be up to date. We are going to start with microeconomics. Okay, we're going to start with chapter 6. This is the first chapter in your blue book if you have one. I did send a PDF version of the textbook on the group, so you have that to refer to if you would like. Otherwise, you just follow the lesson. Okay, so when we go into microeconomics, obviously everything that we've been focusing on so far this year has been macroeconomics. And in macroeconomics, we have been focusing on aggregates. Here, remember, macroeconomics is the study of the economy as a whole. Like in chapter 1, when we calculated the GDP, the GNP, the GDE, etc., those were aggregates. The total goods and services that was produced in the country. It's all about the whole economy. Now we are going to switch over to microeconomics, where we are going to focus on the individual producer or consumer. So microeconomics is when we study the behavior of an individual producer or consumer. We are going to look at different market structures. A lot of what we are doing in chapter 6 and 7, a lot of the theory, all the theory we did do in grade 11, and some of it we even did in grade 10. So market structures, the theory of the market structures is old news. It has been essay questions since grade 10, and they are still essay questions. Today's lesson is just an introduction and a little bit of revision with regard to the calculations and the graphs that we did last year, production cost and revenue graphs and calculations. Okay, so we are still busy with markets. And remember, we said a market can be any place or any situation where buyers and sellers can meet to negotiate, and then transactions can take place. All right, so any place or situation where buyers and sellers can negotiate with one another so that there can be a transaction and goods and services can be used to satisfy human needs. The market can also be defined as the place where demand and supply interact to determine a price at which this transaction can be finalized. Obviously, demand and supply must interact so that we can have a price, and once we have a price, each buyer will decide if he's willing to pay this price, how much he's willing to buy at this price, and the seller will decide if he's willing to sell at this price and how much he's willing to sell at that price. All right, so in the market, if the market is a combination between buyers and sellers, in the market, your buyers, your consumers are represented by the demand curve, and your producers, the businesses, is represented by the supply curve. Now, between chapter 6 and 7, we are going to distinguish between 4 types of markets or market structures. In chapter 6, we are only going to focus on the perfect market. And then in chapter 7, we are going to look at the imperfect market structures, specifically the monopoly, the oligopoly, and monopolistic competition. We are going to look at all of the characteristics of these different market structures, and that is the theory that I referred to earlier. You have done the characteristics of these market structures, the perfect market and the monopoly, you have done since grade 10. Oligopoly and monopolistic competition, you also did again in grade 11. All right, so this is literally the 3rd year that you are hearing about the perfect market and the monopoly. All right, if you still don't know the theory, you have to start studying very soon. All right. Now, when we refer to the characteristics of the different market forms, it always refers to, or it boils down to How are decisions made in that market structure based on prices and production levels? So in each market structure, how do they decide what the price is going to be, and how do they decide what the level of production is going to be? And obviously each market structure has different characteristics, and decision making works differently in each of these market structure. All right, in each market structure the behavior of businesses are going to be different. All right, because it depends on the characteristics of that market structure. For example, how many sellers are in that market structure? That will determine the amount of market power that each individual producer will have in that market structure. And it will be different from one market structure to the next. Right. If we look at the revision, the first thing we're going to look at is the revenue curves. Right. And I did say to you last year, when we talk about the cost and revenue curves, the cost curves are exactly the same for all market structures. But for every single market structure, their revenue curves will look different. So by looking at the revenue curves, you will be able to decide and to see whether the graph that you are given is a graph that is representing a perfect competitor or a monopolist or monopolistic competition or an oligopoly, purely by looking at their revenue curves. The revenues that we did look at last year, the first one was total revenue, the abbreviation TR. Remember, your total revenue is all the income that the business receives when they sell all of the output that they have produced. So the formula to calculate total revenue will be price times quantity. In the perfect market, we are only focusing on the perfect market in this lesson. So in the perfect market, your total revenue curve starts at the point of origin at 0, and after that it is a straight line that slopes upwards. Your total revenue will increase all the time. The more you sell, the higher your total revenue is going to go, because in the perfect market, your price is constant. So at a constant price, the more you sell, the higher your total revenue will be. So if you see a total revenue curve that starts at the point of origin and it is a straight line that keeps going up and up and up until the heavens above, then you know this is the perfect market. Also important is the marginal revenue, or MR. Remember the word marginal. Every time you see marginal, it is about additional. So marginal revenue is the extra revenue, the extra income that the business will receive if they sell one additional unit. So in other words, if I have sold 20 cupcakes, how much extra revenue can I make if I sell cupcake number 21? All right. So how much extra revenue can I receive from selling just one more unit? The formula, and remember from last year, you will remember that the marginal revenue and the marginal cost, these are the calculations that you struggle with. The formula for marginal revenue, that triangle means change. So change in total revenue divided by change in quantity. Change in total revenue divided by change in quantity. Now for the perfect market, and only for the perfect market, your marginal revenue is equal to the price. Okay, so if you have a textbook, like a hard copy of a textbook, you are going to write it down. Yeah. Okay, there's a big space there. I want you to fill in there that in the perfect market, your marginal revenue equals the price. All right. And remember, because the price is constant, I am going to revise that with you when we go to the actual information. But from last year, remember, each individual producer in the perfect market is a price taker. They cannot change the price. So if the market says the price is 10 Rand, then the price will be 10 Rand. They cannot change that price. Okay. So if you just write there for yourself, your marginal revenue in the perfect market, this is only true for the perfect market. Marginal revenue will be equal to the price. And because your price is constant, your marginal revenue will be constant as well. Okay, that is why I say it is a horizontal line at the level of the market price. So if you look at your graph, there on the axis, the revenue or the price revenue, price of cost, if the price is 10 Rand, there it will say 10 Rand, and then your marginal revenue is a horizontal graph at that 10 Rand. Okay, so whatever your price is, that is where your marginal revenue is going to be. And in the perfect market only, it will be a horizontal line. The next revenue we're going to look at is average revenue. Okay, your average revenue is the income that you receive for every unit that you sell. So if you have sold 100 cupcakes, I want to know how much money did I receive for every single cupcake I sold per unit. That is what average revenue is. Okay, your formula to calculate average revenue, you're going to take your total revenue divided by the quantity. Now, very important that you see the difference. Can you see? Marginal revenue is change in total revenue divided by change in quantity. The change there is important. Average revenue, you are purely going to take your total revenue divided by the quantity. Okay, now, again, your average revenue, again, if you have a hard copy of your book, you are going to write in here, average revenue is also equal to the price. This is true for all market structures, okay? Marginal revenue equals the price only in the perfect market, but average revenue, it doesn't matter which market structure you are in, average revenue is always equal to the price. Okay, because if you think now, if we said total revenue, I'll just go back. We say total revenue is price times quantity. Average revenue is total revenue divided by quantity. It is going to give you your price. So average revenue is the same as your price. And again, your average revenue for the perfect market because the price is constant. That is the reason why your average revenue curve is a horizontal line, again, at the level of the market price. So if your market price was 10 Rand, it would say 10 Rand there. And then this horizontal graph would be your average revenue. It stays constant because your price is constant. So in effect, you'll see when we start drawing the graphs that if my price is 10, I'm going to draw one horizontal line. And that one line is going to represent the demand curve, the average revenue curve, and the marginal revenue curve. If we go over to the cost curves, and remember I said the cost curves are exactly the same for all market structures. So if we go to total cost or TC, remember that is the total cost involved in the production of all the units that I have produced. So if I have produced 100 cupcakes, my total cost will be all the cost involved in producing those 100 cupcakes. And remember, your total cost is divided into fixed cost and variable cost. Your fixed costs are those costs that doesn't change when production changes. This is important, and I stressed it last year as well. Right, when production changes. Remember, your fixed cost is not the cost that stays fixed always. It just doesn't change when my production changes. It changes because of other reasons. Okay, rent. Rent is an example of a fixed cost. All right, so we're not saying that rent is always going to be the same. Rent is going to increase next year. Now when you enter into a new rental contract, they're going to tell you your rent is increased by 10%. But your rent doesn't depend on how much you produce. Your landlord is not going to say, you produced 100 cupcakes this month, so your rent is 2,000 Rand. Next month, you produce 10,000 cupcakes, then your rent must be 20,000 Rand. Doesn't work like that. Your rent, your fixed cost, doesn't depend on your output. So it is the costs that remain the same, irrespective of how many goods you produce. It's important that you understand that. Your variable costs, those are the costs that will change when production changes. So in other words, the more you produce, the higher your variable costs will be. If you produce nothing, you have no variable costs because you haven't produced anything. All right. We will talk about fixed cost and variable cost again later in this chapter in detail with examples. Right, to calculate total cost, okay, you're going to take fixed cost plus variable cost. All right. When we go to the graphs, you will see this is the formula that we used last year to calculate the total cost. You will not be using this formula later on in this chapter anymore. On a graph, I'm going to show you how to calculate total cost on a graph. So it works a little bit differently this year. Okay, it's just a different formula, basically. Okay, but total cost plus fixed cost, that is going to give you, the fixed cost plus variable cost is going to give you a total cost. All right. The shape of your total cost curve, it is sloped like a stretched out S. All right. For example, if you have the letter S, okay, if you take this little letter S and you take it by its head and you take it by its tail and you pull it apart, that is what total cost is going to look like, a stretched out S. Remember, your total cost does not start at 0. All right, because remember, there is always a fixed cost. Even if you're producing nothing, you cannot say to your landlord that you are not producing anything, so you are not going to pay rent. He's going to chuck you out. All right, there is always a fixed cost. Even if you're producing nothing, there is still a fixed cost. There won't be any variable cost if you produce nothing, okay, but there will always be a fixed cost. So therefore, your total cost is never 0. That is why the graph can't start there, okay? It does include, remember, your total cost includes your fixed cost and your variable cost. So your total cost can never be 0 because your fixed cost is never going to be 0. So there where your total cost starts. Let's say your fixed cost is 200 Rand. Okay. So when your fixed cost, let's say, is 200 Rand, there on the axis, it will say 200 Rand. That is where your total cost will start. And then remember, your cost increases slowly at first. And when the law of diminishing returns kicks in, that is when your cost starts increasing very, very quickly. All right, therefore the stretched out S shape. But again, I will do this in detail with you later in the chapter. We'll talk about the law of diminishing returns again later in the chapter. Okay. The second type of cost we're going to look at is the marginal cost. Okay, I've already said marginal means additional. So if we're looking at the marginal cost, we are talking about the additional cost involved in producing just one more unit. So if I've produced 200 cupcakes, how much extra is it going to cost me to make just one more? Right, the formula, same as marginal revenue. We're going to take change in total cost divided by the change in quantity. All right, change in total cost divided by the change in quantity. The shape of the marginal cost curve, initially you will see it decreases, it reaches a minimum, and after that, once more, where the law of diminishing returns kicks in, that is where your marginal cost will increase. Right, so your marginal cost always looks like a tick or the Nike swooshy, right? Marginal cost is your Nike swooshy. Then average variable cost. Okay, if we calculate average variable cost, we spoke about variable cost earlier. Remember, your variable cost is the cost that changes when my production changes. So if I calculate the average variable cost, what I'm trying to see is what is the variable cost for every 1 unit that I am producing. So average variable cost, you're going to take your total variable cost and you divide it by the quantity. And you will see when we do the calculations, your average variable cost will decrease initially. It will reach a minimum and after that it will start to increase. All right. The shape of the average variable cost is a U shape. It's shaped like a bowl, the bowl that you eat your cereal in. That is what it looks like. All right. It makes a little bowl. The last one that is important for now is the average total cost. And remember, your average total cost is the cost involved in producing just 1 unit. Okay, not an extra unit, that's marginal. If I have produced 100 cupcakes, I would like to know what each one of those cupcakes cost me. So then I'm going to take my average total cost and I'm going to say total cost divided by quantity. All right, and you will see your average total cost looks exactly like your average variable cost. It decreases initially, it reaches a minimum, and then it starts to increase. Okay, it is also U-shaped or shaped like a bowl. But very, very important is this sentence. Your average total cost is always above the average variable cost. Because just like your total cost will include fixed cost and variable cost, your average total cost includes your average variable cost as well as your average fixed cost. So average total cost will always be more than the average variable cost because it includes also the average fixed cost. All right, so on a graph, the average total cost will always be higher, above the average variable cost. All right, all of this is still revision. If you're not remembering this, you need to dig deep. Right, almost finished. Now, when we refer to costs, we're referring to implicit as well as explicit costs. Okay, this distinction we also did last year. Remember, your explicit costs are the actual expenditure of the business. So they physically, literally paid out money and there's a source document to prove that this transaction has taken place. Okay, so the business has paid the rent for the factory. The business bought raw materials. They wrote out a check. They bought the raw materials. They paid their wages. Okay, all of these things are explicit costs, actual expenditures, things that physically really happened. There was a transaction and there's proof of that transaction. Those are explicit costs. Implicit costs, we're talking about the value of the inputs that is owned by the entrepreneur and that the entrepreneur decides to use in the production process. So it is not something that is purchased necessarily. Okay, it is inputs that is owned by the entrepreneur himself. Okay, now the value of these self-employed inputs must be calculated on the basis of its opportunity cost. So what we are going to ask for us to put a value into these implicit costs, we have to ask if the entrepreneur wasn't using these inputs in this business, how much money could he have earned elsewhere if he used his inputs elsewhere? All right, that is the rate of return. How much would he have earned if he used his resources differently? Okay, the example explains it better. Okay, so if I look at this example, Patrick is the sole owner of a small bakery. He owns the building in which the bakery is situated and he uses his own labor and capital to run the business. Although the bakery has no explicit costs for rental, interest or labor, because he's not paying rent because he's using his own building. He owns the building, so he doesn't have to pay rent. He's not paying interest because he used his own capital, his own money to start the business. He's not paying labor because he's doing the work. He hasn't employed anybody else. He's doing all the work, okay? But by implication, we are saying rent, interest, and wages are paid, okay? This is your implicit cost because by using his own building, Patrick is forfeiting the rental income he could have received by renting out this building to somebody else. So if he wasn't using this building to operate his own business from, he could have rented it out to somebody else. So he could have received rent. He's not, but he could have. By using his own capital and labor, he's forfeiting, he's sacrificing interest and wages that he could have earned by applying it somewhere else. So he's not earning interest because he didn't put his money in the bank. He used his money to start his business. He could have earned interest if he decided not to start his business, but to rather put his money in the bank. But now he's not. He's sacrificing that income. He's not earning wages because he's working for himself. But he could have earned wages if he didn't open up his own business and he chose to work for somebody else. So the wage he could have earned, he's making a sacrifice. Okay. Now, when Patrick calculates his total cost, he needs to include his explicit costs, so all the water and electricity that he's paying for, his telephone account, the raw materials that he's buying, plus we need to include the implicit cost as well. That money that he's sacrificing, the implicit cost is the money he could have earned. He's not earning it, but he could have earned it if he used his resources differently. So the implicit cost would have been the rent he is not receiving, the interest he is not receiving, and the wages he is not receiving. All right, so if we calculate total cost as economists, okay, remember last year we spoke about the difference between accounting profit and economic profit, né? In accounting, you can't take implicit costs into account because there's no source document because he didn't get this money, right? But in economics, we're all about efficiency. So we want to know if he's using his resources in the best possible way. So we are going to include implicit costs as well. Right. Now, I will refer you back to these implicit costs, round about middle to the end of this chapter. I'm going to refer you back to this, okay? When we calculate total cost in our activities, our implicit cost is included in that total cost. All right, so if we take fixed cost plus variable cost to get our total cost, our implicit cost is already included in those fixed and variable costs. Okay, but for economists, what you need to know here is that we include both implicit as well as explicit costs. Last concept is just the difference between short run and long run. We did this last year as well. Remember, the short run is that period of time when at least one of the inputs in the business is fixed. The long run is that period of time during which all of the inputs become variable. Remember last year we said certain inputs are quick and easy to change, variable factors. Other inputs takes time and planning to change, are fixed factors. Now the short run is that period of time and however long it takes. It's going to be different for different businesses. We are never going to say the short run is less than a year. No, we don't talk like that in economics. The short run is however long it takes when at least one of your inputs is still fixed. So the short run, for example, you can increase your raw materials. You can buy more raw materials to produce more. I can hire more workers to produce more. But can I buy a new factory quick and easy? No. That needs time and planning to change. So if it is impossible for the business to expand their production by building another factory, the factory is a fixed input. It cannot be changed right now. Then we are still in the short run. When we reach that point where we have planned and we have borrowed the money and now we have enough money to invest, then we are in the long run. Okay, if we've saved enough money, we've borrowed enough money, we've planned it, and now we are able to buy that extra factory, then only are we in the long run. So the short run is characterized by at least one input that is fixed. Normally, it will be your land and buildings. And the long run, there are no fixed factors. Anything can be changed. Any of the inputs can be changed to produce more or to produce less or whatever the case may be.